The size of this expiration is similar to the size of March of 2020 when we look at it on a delta basis. And to me, that's somewhat mind-boggling. The last 24 hours have really been rather insane. The moves in the market, I mean, you look at this chart and you think, well, on the face of it, not much has happened, but the moves are incredible. Powell spoke yesterday, obviously at 2 o'clock. We raised rates by 75 basis points, and that is what this initial volatility is. And then in there, we had this move, which in about 10 minutes, we gained 100 handles in the S&P, which anecdotally is one of the bigger moves I think I've ever seen in terms of that far, that fast. That's like a flash crash up kind of thing. And ultimately, there was this rally again in the end of the day, 40 points in a matter of minutes, gave that all back. And then futures seemed like they had things going pretty well here. They were rallying. And then there wasn't really a trigger for the sell-off, but it was just slow, steady, cascading, liquidity cascade, right, is the term that Corey Hoffstein uses. And that's kind of what this was on a micro time scale. The bottom line here is that we bounced at this 37 level. There's 30,000 puts that expire tomorrow at this 3,700 level. We documented how those puts went from $40 at the start of the day to $6 at the highs yesterday. They're back to 35, and we're possibly going to stage a rally here. Now, why could we rally? Most of what's been happening has been about macro. The next day or two, yes, macro flows could shift violently over these next kind of couple of days, given everything that's happened, but OPEX really is going to grow in magnification. I want to show you two charts. This is the delta notional by expiration for the spiders, SPX, Qs all combined in one. This figure is a massive figure, and it is one of those numbers where you just say, look, I'm not even going to say what the number is because it's so big, it's just not reasonable. But this is hundreds of billions of dollars, basically. Now, a lot of this risk probably pairs off, so it's not quite as extreme as it may look on this chart. But hold on for my actual point. There are tons of deep in the money puts. For the S&P alone, there's 1.5 million in the money put contracts. Those have a massive notional value themselves, and you add in the SPYs and the Qs. All those puts expire tomorrow. Our view is that not all of those puts are held long by traders and therefore short by dealers, but a good number of them are, and there's probably a lot of short hedges that have to be unwound as options expire. Not only that, if you own one of these puts, you're going to roll it likely down and out, right? You're going to take your in-the-money put and you're going to trade it. You're going to buy a lower strike put that's farther out in time. So the net delta there is a little bit less. That means dealers can buy back some futures. But the point here that I want to show, this is the March of 2020 expiration. The delta notional, now I'm doing here is taking puts, assuming I'm just measuring the delta of the puts. I'm not pairing anything off. Again, most of this should be paired off, so don't take this at the extreme, but the point here is the same. The size of this expiration is similar to the size of March of 2020 when we look at it on a delta basis. And to me, that's somewhat mind-boggling. I want to look at this in terms of the Qs, and you compare this to March of 2020, and you say, okay, here's what the tech drawdown was in March of 2020. We lost about 30%. Well, look at where we're at here, 30%, right? Now, the huge difference, the most critical difference here is that the Fed was launching a massive easing program right at the lows, right on the third Friday of March, right at the point where all these big put options expire. Here, we're doing the exact opposite, right? Everybody is tightening. Everyone's raising rates. So my point here is that I think we're going to continue to get an OPEX bounce today, maybe into Tuesday, but that increase in markets and decline in volatility is likely a good time, we think, to buy put options, to use that rally, a little bit cheaper vol maybe, to look at buying some downside, because by all measures, we are going to do one major thing here, and this is what this chart is also critically important for understanding. You can think about this as the market hedge, right? How big are the hedge positions that are now rolling off? They're huge. So whatever the market was, or whatever the positioning is that has been supporting us, so whatever the position is that's been supporting us as we've had this grind down, right? This controlled demolition. Every single options expiration puts get rolled down and out, rolled down and out, rolled down and out, and we have new lower lows ahead. And I think that between this options expiration tomorrow and then the some sizable positions expiring on June 30th, we just opened the door to lower lows. And I think there are a lot of people looking at the pre-COVID highs, and that starting to seem like a reasonable estimate. I mean, that's very far down from here, but it's very clear that there's tightening across the globe, right? And it's just not a backdrop here for people to want to get into calls and to want to start a spiral high. So yes, we're looking for a rally here, but we think those rallies are going to be a good time to look to add downside put exposure. If you have any questions, please put them in the comment section below or hit us up at SpotGamma on Twitter.